My name is Sherwood Neiss. I am a principal at Crowdfund Capital Advisors. I am one of the 3 entrepreneurs that showed up in Washington, D.C. with this crazy idea that we needed to update the securities laws to the internet age. That story in itself, I think, touches on something that we missed a lot of, I thought, earlier today when we were having the entire conversation about what this market is all about. It's about, sure, it's about supply and demand. Sure, it is about technology and how we bring technology to people that are using it. But who are these people that we're targeting? When you look at the opportunity that exists in this marketplace, we're talking about Generation X, we're talking about Generation Y, otherwise known as the millennials. And so the millennial generation and this Generation X are the people that will be having the capital. These are the people that are online today and will have the capital in the future that are going to be active in these marketplaces. And so that's really what the Jobs Act represents. You've got these parts of it that are enabling capital for startups and small businesses and larger corporations to get capital. But it's different ways in which we can do it. And so we've heard about the ways in which people are using Title III, which is soliciting accredited investors for capital, and now we've got Title IV, which is Reg A Plus, active, but there's one part of it, which is Title III, that I worked on with my business partners, that we have rumors that will be going into effect, hopefully, as early as the beginning of the year, if the SEC comes out with the final rules in October. So that's important in the sense that it really brings this millennial generation online, and I believe personally that it opens up the door to a lot of opportunities, not only for them, but for people that want to actually reach them and have them invest in their companies. The things that I want to touch on in this panel are access to capital, of course, reducing bureaucracy, increasing efficiencies, the role of fintech as it relates to all of this, compliance on the back end, liquidity for investors, the 506C marketplace, which I think is a really attractive one, and how we're integrating this with the venture community. And so we've got this great panel here, and I've lined them up so they match up with their names. And so I just want to take a couple minutes to have you guys go down and introduce yourselves, tell us a little bit about what you do, where you're from, and a couple data points that might be interesting.
Scott Purcell, CEO of FundAmerica. We provide back office, fintech, and compliance services for funding platforms. We don't work with issuers, but we work with the platforms or the broker-dealers who are working with the issuers. We provide a variety of the very necessary under-the-hood components to the process or the ecosystem, such as escrow, confirmations of an investor accreditation for 506C offerings, international for domestic and anti-money laundering for domestic and international investors, payment processing, broker-dealer execution, pretty much any of the ugly stuff under the hood that helps keep people from going to jail. That's our focus. We have platform customers who are broker-dealers, investment advisors, direct issuers, listing services, a variety of others. Doesn't really matter to us. It doesn't matter what their business model is so long as it's legal. It doesn't matter what their application, doesn't matter if it's equity or debt, whether they're doing 506B, C, Reg A. We have offerings across the board. We see small deal sizes from tens of thousands of dollars to the largest deal size, $1 billion. We have Reg A customers going live, a lot of excitement happening. So it's kind of cool that we have visibility into a lot of what's happening in this space because we're providing compliance services for it.
Thank you. Phin?
Phin Upham from Thiel Capital. We are venture capital investors and more broadly investors in Silicon Valley, and we've invested in a number of platforms that do peer-to-peer lending and other kind of sort of democratization of finance as a general theme. I guess it's just nice to have a panel which is talking about the ways in which more people can get involved in Silicon Valley, because I think there's a perception that it's an insider game and only for a few people. And I think that's probably wrong, or in as far as it's correct, it should be less so. And I think that's one theme of the panel today.
Great. Cathryn?
Hi, my name is Cathryn. I'm the founder and CEO of MarketX. We are actually probably the youngest company in this audience. We actually just launched a TechCrunch Disrupt last week. So our platform is a P2P marketplace connecting shareholders or private companies, generally Series C and above, with international investors, also currently in the U.S. accredited investors. So my background is worked in international finance, both in Hong Kong and London, and as I looked into the crowdfinance, which is a really powerful tool, we realized that international democratization of finance is not just about bringing more people, but also broaden the entire space to the international community. So that's also something we're working on. Also, we like to say we're kind of like the Robin Hood for private securities, because we wanted to make it super easy and understandable, transparent for the new generation of investors.
Hi, I'm Feit. I'm the CEO and co-founder of SeedInvest. SeedInvest is a leading equity crowdfunding platform based about a block away from here. And we have just over 12,000 accredited investors who are looking to invest directly in early stage private companies. On the accredited side, we'll do about $9 million of investment volume this quarter. And we're also now participating in Reg A, which has been around for about 3 months. And we've had 3 companies in the past couple months test the waters under Reg A and have attracted close to $30 million of investment interest from about 8,000 people. On the Reg D side, the average investment on SeedInvest historically per person has been $40,000. On the Reg A side, with non-accredited investors, the average indication of interest has been about $4,000, so it gives you a pretty big sense of the differences. And got involved in this world back in 2011, working on the Jobs Act with Woody.
Blaine.
Blaine McLaughlin from Folio Institutional. I head our private investing business. And for us, that really breaks into a couple of different pieces. Primarily, that's been a platform for underneath of other platforms. So if you think of cash movement, bankless, escrowless, paperless, custody, servicing of investors, servicing of issuers, things like that, that's our core platform as a clearing broker-dealer. We add on to that the capability for either hosted website or API-based connections for broker-dealers, for serial issuers, and even standalone issuers should they choose to go through our evaluation funnel. I think about a week and a half ago, we started launching the Via Folio platform for issuers, and there are firms raising money on there now, in addition to a number of primary and secondary offering sites that are using us as the back end. So we'll talk more later.
Perfect. So what I really want to, what I like and want to point out about this panel is this doesn't represent one company coming at it saying, we have all the solutions and we're going to provide this to you. You've got traditional players that are in the marketplace that are saying, this is what we do and we're going to continue focusing on that. And then you've got new entrants that are coming in, not necessarily saying, this is a silo, but I need to partner with you, and it's how we get this capital stack moving to get people through it along the stages, and other people that play important roles along the way that help you become more transparent and accountable on the way. So I think that's important when you're thinking about this entire ecosystem, that you're not just thinking about it as a silo, that people are not necessarily unbundling it. If they're unbundling it, they're doing it because they want to focus on something that they can have efficiencies at. And so that really comes down to my first question, Ryan, which is for you. The Jobs Act held many promises. One was access to capital, another one was reducing bureaucracy, another was increasing efficiencies. Given your experience with SeedInvest, what proof do you have that we have or have not seen the intent of the Jobs Act come to fruition? Who has seen the greatest benefit to date? Has it been investors? Has it been entrepreneurs? Have the regulators won because they've been dragging their feet?
Well, I would say holistically, we've seen very little when you look at the bigger picture in terms of the promise of the Jobs Act. If you look at the report Goldman Sachs put out a few months ago, they projected that crowdfunding is potentially the most powerful of all of the sort of new technologies evolving in finance right now. So that includes wealth, right, with companies like Betterment. That includes more online mortgages, student loans, et cetera, payments. And they estimate that there's potentially $1.3 trillion of potential disruption from crowdfunding. We've seen a very, very small fraction of that realistically so far, and a lot of it has been due to the Jobs Act taking way longer than we all thought it would be. And so what has happened so far is if you are, I think, a good company, it's easier to get your round closed for a couple of reasons. One, with the Jobs Act, we're now allowed to aggregate investors online in one place. And if you're a good company that has sort of been vetted, it's easy to fill it around from those investors. So we've streamlined it through the network effect of being able to aggregate investors in one place. And then, as a lot of people on this panel will talk about, the technology has streamlined things a lot. So the ability to accept e-signatures very quickly on documents and not have signature pages floating around, the ability to move money very easily through things like ACH is much better than 50 angels sending checks in the mail. So we've definitely seen things get streamlined from a technology perspective. We've certainly seen investors aggregated together, which has helped sort of speed up rounds to get it closed, but I don't think we've seen 1% of what we're about to see the next 5 to 10 years. And for me, I think seeing what happens with Reg A over the next year, and potentially let's see what happens with Title III. But I think that's what a lot of us are waiting for. And I can talk more about why that's a big deal in terms of disruption.
Do any of the rest of you think, in terms of that report that came out, that this tidal wave is about to approach, and that we're about to see something with the advent of Title III, and based on what we've been seeing here today and hearing about people that are playing in this marketplace of marketplace lending and the growth, and it's nothing to sneeze at the size of that market that it is already today, it would seem like there's a huge, we have to go a far distance to get from where we are today to what they say in the report. How do you think we're going to be able to accomplish that?
Well, the first part of your question, from what we've seen, is we service we have almost 200 platforms signed up, so it's a great variety, but almost all of them are after accredited investors, and it's a slog. It's a lot of work for them to find the accredited investors, nurture them, develop them, and get them going. It's not a tidal wave of money that everyone would like. Once we're allowed to let the non-accredited investors play, which you've had a key role in, we're seeing a lot more excitement. Two examples. One, we've got a platform in California that is relying on intrastate exemptions, and they're doing for non-accredited investors, and they're running radio ads. They've raised tens of millions of dollars at very low rates compared to what I, as an accredited investor, would look at. And then we have another customer that's doing testing the waters for Reg A. They're hopefully going to come out soon. LEO Motors, you might have heard of them. They're doing a lot of PR. They've got $37 million in commitments from over 10,000 investors so far, ready to go and fund the company. So the non-accredited bubble that's built up and is ready to unleash a tidal wave of capital, it's there. It really exists. So once we get Reg A developing and then ultimately Title III, we're going to see a lot of capital formation in this country.
I have a little different view on that. So yes, and as opposed to but. If you view the investment dollars as roughly half taxable accounts and half IRAs and 401ks and 401k rollover, and in parallel you view that about 80% of the money in the US is advised and managed by somebody other than the person who owns it, we, for the most part, as a group, as an industry, are only serving the remaining 10% of the capital, the self-directed individual investor in a taxable account. And to get those bigger numbers, we actually have to put solutions in place that investment advisors and brokers want to use and that support IRAs and IRA money in these private investments. And we can talk about how to do that in a few minutes.
Okay, great. So Scott, stepping back for a second, there's one thing that we realized, and that's financial technology plays a huge role in all of this, and it's ushering in this new form of finance. How did the Jobs Act open up these opportunities for you, and what would happen without this back office technology that you're talking about under the hood that we need?
Well, when I initially read about what was then the Entrepreneurs Access to Capital Act in the House of Representatives, it was obvious that if this were to come to fruition, you're able to use technology to drive investment, reduce friction in the overall process to make it easy for people to participate, that it could change things. But there's a lot that goes in that. We're in a highly regulated industry. You've got the SEC, you've got FINRA, you have all the states, which is another 50 mini SECs, each with their own regulations that have to be accounted for. You have Patriot Act with you have a whole bunch of regulations that are easy to go sideways from. So the back office, how to process it, how to do so in compliance with laws, how to do so with minimal friction on the investor, on the issuer, on the platform. It created an enormous opportunity for somebody to step up and do that, for a variety of people to do it, and for any firm, any platform, anyone raising capital online to, again, I'll say it for the third time, reduce friction in the transaction process so that you can then speed up the cycle and widen the access to deal flow and capital.
Is there a standard operating procedure for all back-end services, or is there a way in which you accomplish 80% of it and let the companies figure out the other 20%?
Well, at FundAmerica, we do probably about 80% of it. Some things we've been kicked into dragging and screaming by our customers. We didn't want to do payment processing for people sending distributions to investors. We got forced into doing that. We didn't want to do confirmations of investor accreditation for 506C. Nobody else was doing it in a good manner, so we got forced into doing it. Just one thing after another we've been dragged into. We're now about to do 1031 exchange capabilities for people online. So a lot of this is evolving, and you get trapped or you get pushed into doing it by the customers. The market tells you what it wants you to be. Prior to that, people use a variety of things. They might use US Bank for escrow and another thing for a confirmation, another person to send payments to investors, and kludge together a bunch of sources. But now there's the opportunity for firms like us and others, Folio is doing a lot of stuff as well, to automate many of these back office things and reduce the cost of them.
Okay, that's great. And that's when we were thinking about the Jobs Act and we were thinking about what this means, and when we travel around the world and talk about this, one of the things I think that resonates most with people that are coming into the marketplace is the fact that if you can standardize more of this, then investors can actually have an easier way of understanding what's happening in these companies. Granted, there's nuances that will always change, but if we can have a standard format for which companies are completing information, then investors can look at it and they can compare other companies and make better investment decisions. Here's Cathryn. So you're focusing on secondary markets. You're focusing on liquidity. One of the things that I always like to say is there really would be no market if there were no money out, okay? So there has to be, in order to have money in, you have to have money out, because investors aren't going to put any money in if they know they're not going to get it out. Why did you focus so much on liquidity for investors, and what risks do investors have in buying shares in the secondary market?
Sure. So to answer the first question, why did I focus on liquidity? So actually, it's a bit unplanned. So my previous experience was working for JP Morgan Investment Bank in Hong Kong, and we've seen the pre-IPO market for Alibaba and also Twitter shares. There was just so many interests in that market. And also because we all know that the market currently, IPOs are getting delayed. A lot of the shareholders, whether it be investors or employees, are really the ones suffering from this. And we have a lot of investors who mention, they've invested in a company for like 10 years and they can't get anything out of it. On the employee side is that they're the ones that help the company to get to where they are today. And yet they have no transparency, understanding how much the shares are valued at, and generally they have no venue to do this. So what we are trying to do is really help people to understand that we need to increase the transparency, but at the same time allow people to have the freedom to understand we can have partial liquidity for employees or investors who have the needs. So for example, we've conducted a survey amongst 100 companies who are in the pre-IPO unicorns category, and a lot of them say currently they're considering giving people partial liquidity because it's really hard to incentivize the workforce because there's so much competition for talents. For example, a company that's basically the Uber of Singapore, they have a really hard time finding employees who are willing to move from Silicon Valley to Singapore. So for them, giving them the ESOP option program, also giving them partial liquidity would really help. On the other hand, also because I worked at the startup previously, and I was also in a seat where I saw my fellow PhDs from Stanford driving a $50K old car that breaks down every single day, and it's because living in San Francisco is expensive. So I wanted to solve the problem for my friends, my fellow colleagues. So that's the reason why I also wanted to start a secondary market, helping people solving the liquidity problem. On the risk of associated with the secondary market is obviously the valuation for late-stage companies are really hard for anybody to understand at this point. We focus on sort of Series C and above companies. So we understand that in the Series A to B, it's really hard for people to put a value to it. But however, post-Series C, there's the private VC world that helps people with evaluation. Generally, we look at how much is the range. So in order to protect companies from having crazy investor wants to put down like too much of a discount or too much of a premium, we actually in our auction system help people trade between a range with a company's consent. So that's how we're dealing with that problem. And secondly, it's about integrity and also ownership of shares. There's a lot of people currently, Silicon Valley especially, are sort of participating in the gray market. And I think that's a very interesting but also risky behavior. So for us, we're working with companies, I can't disclose too much, but we're working companies that are allowing the blockchain to prove the integrity and also ownership of the shares. So those are the things that I think are some of the risks associated with the secondary market.
Okay, but at the end of the day, if you haven't been transparent as a company, if you haven't built value, there's not going to be too much value for that company on a secondary market. So I love the idea of these secondary exchanges. I know when we showed up in DC and had this conversation, we put in Title III, there's a 12-month holding period on the actual securities. But after that, they can be freely traded. And there was a lot of questions about who's going to be buying and selling these securities and where it's going to happen. So it's fascinating to see, again, as these markets emerge, that you've got players that are coming in to play a role in that space. Blaine, so when we look at the 506C market, why is it so appealing to you? And do you feel that this might disrupt the incumbent brokers in the marketplace, or will all brokers be using these technologies to match supply and demand in the future?
I sort of have a love-hate relationship with 506C. Get the hate out. The enhanced verification accreditation requirements are not well loved by investors, and I think might lead people over time to not use 506C nearly as much as anybody had thought that we would or hoped that we would. The love part is that you can actually be transparent about what's being offered. You can say what your offering is, you can say why you're offering it, you can say why you think it's worth what it's worth, and you can, now everybody up here and everybody in the room is sort of already doing this, but you can take what the bulk of private transactions, the method from being big stacks of paper with the guy that you know, often at the golf club or somewhere else, with a check mailed off to some escrow, and you can change that entirely to having complete transparency of a market of who can see what offerings are available and what they might want to invest in. If you take that much, much further towards its conclusion, you have a large marketplace with a large number of offerings with complete transparency as to what they are, so that a person, whether it be a self-directed investor or an advisor, can actually build diversified portfolios of private securities, so that you really change the risk paradigm from being something that it's large investment amounts in a very small number of offerings to being very, very small investment amounts in a very large number of offerings. That's transformative. That's what's going to allow a lot more capital to come into small companies, because it's no longer a gigantic risk bet for an accredited investor. It's a small investment by a very large number of people. For me, as a Folio person, I'm trying to focus on two things. I think it's two things we're all looking for, but in different ways, is to create trust for the investors and to create ease of use for the investors. So when you talk about standardization and standard offerings and standard listings, that's a step towards ease of use. When I talk about most of the money being only from investment, or managed by investment advisors and or in retirement accounts, ease of use to me means I've got an account already. Why can't I buy these products in that account I've already got? Well, at the moment, I can't go to my E-Trade account or my Schwab account and buy Nuco or Prosper Loans or whatever else I want. But that's what we're building and have from the technology standpoint built at Folio and look to make available to all the people that work with us, is so that you can buy these private securities, whether it's 506C, 506B, Reg A Tier 1, Tier 2, Jobs Act. To us, they're all securities and they all fit nicely in accounts. And there is a structure of clearing broker, introducing broker that's been pretty well figured out over the last 50 years for public securities. We'd like to leverage that same structure for private securities, so that whether yourself or your broker or your advisor, it's just another asset that you buy in your online brokerage. So having the asset mechanism and then the marketplace where you can see them and have a really broad set of choice at reasonable purchase prices, I think is key and really exciting for raising a lot more capital.
I'll just tee off on 506B versus C for a minute. A lot of law firms, a lot of attorneys are not even letting their clients use 506B to raise capital because unless it's a very closed and immediate group of investors. What happened before the Jobs Act, the SEC didn't really have a standard. They just had 506D, and people would push the boundaries a little bit. Now, if somebody pushes the boundaries, the SEC can say that should have been a 506C offering. So if you're raising money and you file a Form D, but you're still raising money, and somebody takes the Edgar listing and a media outlet publishes it, you just lost your exemption. Somebody that you're raising money, you go pitch an angel group as a 506B, Tech Coast Angel, Keiritsu, something like that, and one of those guys there then talks about it on Twitter, you just lost your exemption. Somebody in your firm talks about on their Twitter or Facebook, oh my God, the company's raising money, we're so excited. You just lost your exemption. So if you're trying to run a 506B offering in the this day of social or age of social media, it's almost impossible to maintain the exemption. You really have no choice almost but to go with 506C. And yeah, you do have to confirm an investor's accreditation, but it's really not that hard.
So Phin, we've just heard all these people that are playing an important role in the marketplace and the evolution. You're in a family office, you're investing in fintech, you're looking at opportunities like this, you're also seeing this ecosystem evolve. How do you think strategically about how you plug in, how you utilize, how you benefit from the deal flow that's coming through when you see everything that's evolving on the stage in front of you?
Philosophically, more money, if it leads to more entrepreneurs and more startups, I think that could be a really good thing. The concern, of course, is that more money just leads to higher valuations, and that could be a worse thing. So I was in New Zealand, and I remember the New Zealand government set up a program called NZIF in which they basically matched any money that was invested in a New Zealand startup. So you can imagine like put in $1, they get $2. And to the investor, and then you could buy out the government at like a 7% over the 10-year rate for New Zealand 10-year bonds. So you could basically double your returns. And in some cases it created good companies, but it also created a flood of startups, many of which weren't good startups, but in a crowded space in which one could argue that there were fewer successes because you had more competition and not as strong competition. There could be some danger if it cuts the wrong way. I'd almost put it in 3 buckets from best to worst outcome. Best outcome is like the transaction cost outcome that you mentioned, where it allows more people to invest in more things, encouraging more good investment and more outcomes where you sort of democratize finance. Mm-hmm. Second bucket would be like, remember how going through the airport was before 9/11? It was like an easier process. And then after 9/11, it was like the worst process ever. And now you go get pre-check, and it's exactly the way it was in 2000. So it's like the government just made a new law that you have to go get pre-check, and then you get to go back to the way it was 12 years ago. So it's like, what's improved? I don't know if anything's improved, but like they made the system really hard, and then they made a new law which made the system back the way it was before. And how it's relevant is, we have public markets have gotten to be less and less attractive from a regulatory perspective. You've gotten tons of regulation on public companies, tons of disclosure requirements, tons of filing requirements, tons of liability requirements in terms of additional laws and trading laws, insider trading laws. And so, the number of public companies has gone from its peak to what's projected to be half the number of public companies that exist in public exchanges in the next couple of years. So you've gotten public markets a much less attractive place. Now the government creates a new law to open up this new thing, which basically turns private investment into exactly what public investing was 15 years ago. So the second bucket of outcomes would be that the government's just sort of fleeing its own regulation. It can't turn back the clock. And so now this private market will essentially replace public markets. And you've seen that in Silicon Valley. A lot of companies are choosing not to go public. So maybe that's the second bucket. And that's fine for all of us, right? The third bucket is like, the dumb money's coming in, and now finally we've unleashed all these people who are unqualified investors who are unable to do diligence. They're going to get marketed by scammy people who are going to put money in to like exit all the guys who got in money earlier who were qualified. And that would obviously be the worst outcome, and we all hope the regulators are thoughtful enough to prevent that, and that's sort of the challenge. What it will certainly do, if this is successful, is increase the duration of investments. So you had like Hillary Clinton come in recently and make a proposal to increase the tax on gains for stocks you held for longer than certain periods of time. Certainly, as people invest in private markets, this is going to increase the forced duration of people's investments because you can't get out of it as easily. Even if Cathryn's successful, it's not as easy as just selling on, Charles Schwab. And I think that'll change the dynamics of a crash and a volatility in markets to the better. So I'm optimistic in general, and I hope it's the first bucket. I suspect it's somewhat the second bucket, and I think we should all work hard to make sure we avoid, whether it's regulatory or a social response, the third bucket.
When we look at that third bucket and the fear of unaccredited, unsophisticated investors coming into a company and being on the stock table, do you think that, are there ways in which you're thinking if we identify a company that we want to invest in, and they've crowdfunded, for instance, and they've raised capital, but they've got some investors that we don't think we want on the cap table, have you thought of creative ways in which you can get them to exit, per se?
Gosh, it's not clear to me you'd want someone to exit unless they were like calling your HR up your like investor relations department too much, which you can just not answer their phone call, I guess. I mean, look, it's going to increase the number of people in two buckets. Currently, only 7% of accredited investors approximately are actually invested in private companies. So it's like you could 10x the number of investors just that way. And the new solicitation laws to increase the extent to which you can solicit investments and lighten them will do a large job of just increasing the number of accredited investors in these companies. That's a huge benefit and not one that I think has been gone into too heavily in this talk so far. The second way is getting unaccredited investors in, which is a whole other bucket. I suspect it doesn't really matter who the investors are. Once they've given the money, they've given the money. Though, you're going to get the grandma who needs the money back, and, she's not going to be able to liquefy it, and that's going to be potentially a PR nightmare, if not a legal nightmare.
Ryan, have you had any
I was just going to say, I agree with a lot of things that Phin said. One thing to sort of look at, I don't know if this is a 9/11 scenario, but let's say the public markets continue sort of to correct, right? And we have a big correction, and you look at what happened in Q2, basically the late stage investing was up 400% versus a year ago in Q2. And if you look at early stage, it was up 30% versus a year ago. So even though there are more accredited investors clearly investing in companies now, and that's been a result of Title II and people using platforms, it really hasn't moved the needle at all from an early stage perspective. And I suspect that if there is a correction, it's definitely going to be the later stage that gets impacted, and that's caused by mutual funds and hedge funds moving downstream because the public markets don't have the juice that they once did because companies are staying private longer.
Are we going to see more companies stop seeking a route of an IPO because we don't have the potential for the regulations are too burdensome? But at the flip side, I look at the valuations of some of these companies and I wonder where's the money to be made when they do go public. If Uber were to go public today, what's in it for me as a retail investor to buy in that company now when it's so highly valued? Where's the middle ground?
I mean, that's why you have hedge funds and mutual funds moving downstream because basically 15 years ago you had Microsoft, Amazon, Cisco IPOing for $500 million and now are worth 500 times that. And when you have Uber at 50 billion and you had Facebook at 100 billion, there's just not that much value to capture in the public markets anymore.
And look, it could well be true that private companies are able to be more innovative and have longer time horizons as investors and company builders than public companies are in the current environment. So I mean, that may or may not be true, but there's an argument to that. It's clear that a lot of private companies could be overvalued right now, but could also be that there's value in being private and having longer time horizons and stickier capital.
Right.
Keep in mind that today we have almost 50% fewer public companies total than we did 15 years ago. So not only there's only less choice in the public markets, it's harder to go public, it's harder to maintain a public company. So what we're going to see, what I believe is the future of capital markets, is alternative exchanges.
Well, good. That's what we're focused on. Okay, well, so with that, I think that's a beautiful, clearly it's time to drink.
We have one more.
We've got one more. Okay, Luan just told me, do not move from your seats. There's a closing keynote. I would like to thank this great panel for their insights, and thank you very much.